Hello and welcome to this video. In this video, we are going to do a A-level question from paper 3 specimen paper 2023 question 2. The question states that ZPLC had the following balances at 1st January 2020. Ordinary share capital with a share face value of $2 per share and the total is $500,000. General reserves is $40,000. Retained earning is $460,000. 4% debenture repayable in 2031 is $400,000. In the A bit of the question, we are asked to state two reasons why a business may have non-current liabilities even though it may also have substantial retained earnings. There are many reasons why a business may have non-current liability, like a long-term bank loan or debenture or any other long-term loan, even when they have substantial amount of retained earnings. Some of the reasons are given below. First thing is that retained earning is not equal to cash. Retained earning shows that the business is profitable. They are earning so much profit that they are able to even retain the profit back in the business. So that shows the business is profitable. But all profitable businesses may not be successful because they may be facing liquidity problems and this may lead to insolvency. Why? Because this profit may have already been invested in some other non-current assets or in other expenses, and as already this profit is invested, they may have some liquidity issues, and for this the business may need to go for other non-current sources of finances. Then other reason is when a business want to take a huge decision such as entering a new market or acquisition, diversification, modernization, and other such decisions which require a very huge amount of finances or huge amount of funds to flow out of the business, and retained earning may not be sufficient enough to finance all this kind of decisions, and for this reason the business may go for other non-current liabilities. Like here they went for debentures, they may go for bank loans, they may go for other long-term loans to fulfill the requirement and for expansion and diversification. Furthermore, additional information is provided. The following information was available for the year ended 31st December 2020. First, during the year, a long-term bank loan of $200,000 was taken. The interest charge on this loan by the year end was $14,000. An interim ordinary dividend of 6 cents per share was paid on all the issued share at 1st January 2020. The taxation charges for the year was $10,000. 200,000 shares were issued at a premium of 75 cents per share. The profit from operation was $105,000. A transfer to general reserves was $25,000 was made. A final dividend of 8 cents per share was proposed on all the issued share at 31st December 2020. In the B bit of the question, we are asked to prepare the statement of change in equity for the year ended 31st December 2020, and it should also have a total column. Before preparing the statement of change in equity, let's do the calculation in our working notes and then we will make the statement. First, here it is given, the interest is given directly, so we don't require any calculation there. Next, we have interim dividend, which is 6 cents per share, and the shares, the total number of shares which have been issued on 1st January 2020. The share capital was given as $500,000 and the share price for each share was $2, so $500,000 divided by 2, we get the total number of ordinary shares on 1st January 2020 as 250,000 shares. And when we multiply this with 6 cents, we get the interim dividend as $15,000. Next, we have taxation, so we don't require any calculation for that. Then we have a other issue of shares which is issued at a premium of 75 cents per share, which we will do the calculation in the next working notes. Then we have the operating profit which is given here, so we'll take the operating profit as $105,000 so that we can calculate the profit for the year, which can be mentioned in the statement of change in equity. For this, we will subtract the financial expenses. In financial expenses, first we will have interest, and here interest is given as $14,000. If you remember from the previous part, we got the 4% debentures of 400,000 debentures was mentioned there. So for this, the interest will be 4% of 400,000, which will be $16,000. Then here the taxation is mentioned as $10,000. So we subtract this taxation as well. So we get the profit for the year as $65,000. Next, it was mentioned that 200 100,000 shares were issued at a premium of 75 cents per share. So for this, the calculation will be the issued share capital, which will be $2. That was the share price which was mentioned, times 200,000 shares. We will get the issued share capital of ordinary shares as $400,000, and then the share premium will multiply it with 200,000 times 75 cents. Will get $150,000. Furthermore, it was mentioned that a final dividend of 8 cents per share was proposed on all issued share at 31st December 2020. This was just the proposed one, it was not paid. Hence, it is not yet approved by the AGM, by the shareholders in the AGM. So once it is approved, then it will be paid. As it is not paid, we will not mention in the statement of change in equity. It will be just a note mention as this was the proposed dividend. As we are done with all the calculation, let us now proceed and make the statement of change in equity for the year ended 31st December 2020 for ZPLC. We'll have different columns, like we have ordinary share capital column, we have share premium column, general reserve column, retained earning column, and a total column which was mentioned to be added in the question, and all these figures are in thousands. So we'll start at 1st January 2020. The ordinary share capital was given as $500,000, the general reserve was given as $40,000, and the retained earning was given as $460,000. So when we add this 500 plus 40 plus 460, we get the total as 1,000. Then we have the interim ordinary dividend paid, which we calculate in the first working notes, as we give this out from the retained earning. Hence, this is subtracted from the retained earning as well as from the total. Then we have the issue of shares, which was calculated in the fourth working notes as the ordinary share capital, which was calculated, was $400,000, and the share premium, which was calculated, was $150,000. So when we add this 400 plus 150, we get 550. Then we have the profit for the year, as this will be the retained earning, and this we have calculated in the third working notes. Hence, we have mentioned this in retained earning as 65 and in the total as 65 as well. Then we have transfer to general reserves. This was given in the additional information, and this was the sixth additional information which was mentioned. So general reserves, as this is an inflow in the general reserve, hence it is $25,000 here, but it is given out of the retained earning. Hence 25,000 will be subtracted from the retained earning, plus 25 minus 25, there will not be anything in the total. Then at December 31st 2020, what we are going to do, we are going to total up all the columns from both the sides. Here we have 500 plus 400, which will be 900, 150 will be mentioned, 40 plus 25 will be 65, 460 minus 15 plus 65 minus 25 will be 485. Now when we total it up from this side, it was already 1000 minus 15, 550 we are adding, and 65 we are adding, we will get 1600. And from this side, when we total it up, it is 900 plus 150 plus 65 plus 485, we will get 1600 as well. In the C bit 1, we are asked to calculate to two decimal places the gearing ratio of Z PLC at 31st December 2020. The gearing ratio is equal to, we have a formula, fixed cost capital times 100 divided by total capital. The fixed cost capital, how do we get? We take the non-current liabilities and that will be the fixed cost capital. Then we have the total capital. For total capital, what we'll do is we'll take the issued ordinary share capital plus all the reserves, that is general reserves, retained earnings, and the share premium. Then to this we add the non-current liabilities again, and so this is the formula to get the gearing. And in the gearing, first we will calculate the non-current liabilities. It was mentioned the debentures in the beginning, which was $400,000, plus in the additional information it was mentioned that a long-term bank loan was taken of $250,000. So when we add this to, we get $650,000. Then for the issued ordinary share capital plus all reserves, that is the general reserves, share premium reserves, as well as the retained earning, we have done all the calculation in the page B of this question, and we got $1,600,000. And then what we are going to do, we have to add the non-current liabilities as well, and non-current liabilities which we have calculated here. So we take this and add this up to $1,600,000, we get $2,250,000. Now we will find the gearing ratio, and the gearing percentage will be equal to $650,000, which we got it as a non-current liabilities here, divided by $2,250,000, which we got as a total here, times 100, we get the gearing ratio as 28.89%. Next, in the second bit, we are asked to calculate the interest cover ratio of ZPLC at 31st December 2020. For this, we have a formula. Interest cover is equals to profit from the operation, because we pay the interest from this profit from the operation, divided by the interest payable. And the interest payable we have already calculated. This was the 14,000 which was given the additional information, and this 16,000 which we calculated for the debenture. So the total will be $30,000. This was already already done in our third working notes previously. And now what we are going to do is we are going to find the interest cover, which will be equal to $105,000, which was given in the additional information as operating profit, divided by $30,000, which was calculated here. We will get 3.5 times, that is, we will be able to pay the interest 3.5 times in the given year. Furthermore, additional information is provided. The business had issued the shares and have taken a bank loan in order to finance an extension to the factory. At the AGM, one of the shareholders stated that rather than issuing shares, the company should have financed the extension entirely by the basis of a long-term bank loan. In the debate of the question, we are asked to calculate the revised gearing ratio to the two decimal places if the shareholders' proposal had been adopted. And now here we see he want to take the loan, bank loan, instead of issue of shares. So the issue of shares which we have calculated in the fourth working notes, the ordinary share capital which we got because of the issue of the shares was $400,000, as well as there was a share premium of $150,000. So the total amount for which we got by issuing the share was $550,000. Now in place of this, it will be a long-term bank loan. And now if we calculate the non-current liabilities, we have debentures of $400,000 and the old bank loan which was $250,000, plus this which they want to take instead of issuing shares, it will be $550,000. So when we add all this, the non-current liabilities will be $1,200,000. And the issue of share capital plus reserves which we have calculated in bit B, now it will be different because we will subtract this $550,000 which we have added because of the issue of shares and the share premium. So we will get this ordinary share capital as well as all reserves as $1,050,000. So now again we are going to add this non-current liabilities to the share capital plus all the reserves to calculate the gearing. So it will be $1,050,000 plus this total which we got, $1,200,000. Again we will get the same total as $2,250,000. Now if we calculate the new gearing, it will be $1,050,000 divided by $2,250,000 times 100, it will be 53.33% for the new gearing ratio if the proposal of the shareholder was opted. In the second bit of the question, we are asked to advise the director whether or not they should agree with the shareholder, and we have to justify the answer. You can say agree or disagree based on your point of view, but from my point of view, I disagree with this, because here if they go for this option which the shareholder have said, this may lead to a very high gearing, that is, it will cross 50% of the gearing ratio, and there is a thumb rule of gearing ratio that 50 or less than 50% of gearing ratio is appropriate for most of the businesses, because this may not lead the business into a risky zone. But if it exceeds 50%, that means the business is already in the risky zone, and when the business is already in risky zone, that is, they may not be able to fulfill the loan repayments, either the capital of the loan may not be repaid properly or the interest may not be paid properly. Hence, based on this, the banks may be reluctant to give the loan, and when they are reluctant to give the loan, they may charge a very high interest to give this loan. Apart from that, the interest cover is usually paid from the operating profit. After operating profit, we pay the interest and then we get the profit for the year. And as we have to pay interest, which is an expense, so we may have less profit for the year, which will be again a problem for the shareholders. Why? Because they get the dividend from the profit from the year, and if they don't have sufficient retained earnings or sufficient profit for the year, naturally their dividend may be reduced or they may not be given any dividend, and this may also not be okay with most of the shareholders. So this may also lead to problem. Apart from that, you see interest have to be paid whether you make profit or not, and even if you are making profit you have to pay the interest. But profit and cash may not be the same, because we have already seen in the cash flow statement that profit and cash are two different things, and if the company may earn profit but may not have sufficient cash balance, and if they don't have sufficient cash balance it may lead to liquidity crisis or insolvency, and hence it will be more difficult for the business to fulfill the requirement of the interest payments. So they have to make sure that they should have sufficient cash balance to pay this interest. So this may also be a problem if they go for what the shareholder have suggested. In the EBIT of the question, we are asked to state two factors a bank might consider when a business applies for a loan. The first thing which they will consider is what is the reason for the loan is taken and how they are going to use this money which they have borrowed. Then the next thing which they will see is whether the business have the ability to pay the interest as well as to pay back the principal amount which they have borrowed, because if they don't pay the interest or the principal amount, then the bank will be in problem. Then the other thing which they will see is whether the business is profitable enough to pay this interest as well as the principal amount back. And it's not always that profitable business will have sufficient cash flows, because cash flow and profitability is not one and the same thing. So as profitable business may not have sufficient cash flow, this may lead to insolvency and liquidity crisis. So they have to see whether they have sufficient cash flow to pay the interest or not. Apart from that, the bank will also consider all the assets, whether they have sufficient assets to mortgage against the loan or not. And if the business is not able to pay back the loan, the bank may sell the mortgage asset and get back their loan. With this, we have completed this question. Thanks for watching my videos. Have a peaceful and blessed life.